I think we've had a rolling recession through different parts of the economy at different times. Truck drivers, huge recession, car companies, big recession. There's a bunch of indicators that show that. The tech companies, don't forget, they laid off all of their staff beginning of the year, and continuing claims are rising again. So somebody else is laying off workers now. So I think it's been ongoing, but I think this quarter and next quarter will be the weakest because the ISM is at its lows, and the ISM is at levels, which is the best indicator of the business cycle, is around 46, which has historically given us a 100% chance of recession. So I think we're probably in a recession, but it's been this kind of rolling recession. So my view is always it's never going to be a bad recession. It'll more be like 1990, which is a mild recession, but with a lot of overhangs afterwards. Commercial real estate being one. Unemployment will be stickier than people expect because of the rise of AI and other things. But I think the market's priced it in. The forward-looking market's priced it in last year. Crypto was down 80%. NASDAQ was down 38%. And then I think that the other markets like the Russell 2000, the oil markets, copper markets, all of that stuff is pricing it in today. From our work, we put together, for example, the last 5 major inflations since World War II, and then just map this current one against it. It's identical. They all kind of are the same thing. They go up and go down. It looks like Mount Fuji. It's almost symmetrical. We're seeing it already in Europe where PPI numbers, Norway hit a negative 42% PPI. I mean, this is staggeringly disinflationary or deflationary. So my view is that when we see the kind of November, December inflation numbers in January, we will start to see inflation at 2% or lower. And that will continue, I think, to potentially deflation in the headline numbers. The core inflation and headline inflation is actually driven not by commodity prices and all of this fast-moving stuff. It's actually driven by 2 things: wage increases and owner equivalent rents, both of which are going down, are deflating. And all the forward-looking indicators suggest that they are likely to go negative. So I think there is a chance even of core inflation going negative in 2024, which is very much the opposite of what anybody else's view is. Most people, I think there's myself and Alex Gurovich are the only 2 people who've got this view. Almost everybody else thinks we're going to see sticky inflation. I just don't think we will. There's a lot of false narratives in macro, and a lot of it is based on politics. People put their political views into their economic views and then create market views around them. So there's a general desire for a recession and markets to fall. And that's driven by people who are really all about how is inflation created? The central banks have destroyed our world, and I want to show everybody that it's happened. Yes, the central banks have destroyed our world, but not in the ways that they think. We've had the use of the balance sheet for over a decade now, and in Japan even longer. It never generated inflation. But they want that inflation because they want to prove that the monetarism is the kind of holy grail that they worship. And it's the people who worship Volcker, for example, come with different angles. So a lot of people are imposing perspectives that they hold from political opinions. And so the narratives become overwhelming. And I've actually gone on Twitter and said, okay, if you think sticky inflation, how do you vote? Sticky inflationists are Republicans in general. And it's just because of how the construct of how people see the world. What I try and do is not look at that. I mean, at Global Macro Investor, we have 2,000 charts. And we just try and use the data, not impose our own views on the data, and see what that comes out with. And that gives us the high probability that inflation just reverts back to 2% or lower. Doesn't mean I'm definitely right, but it comfortably gives me a decent probability, I think.
Hey Money Talkers, welcome back to the Crypto Showdown, where the drama never stops. Today, we're diving into Juke Morgan's cautionary tale for Bitcoin and RK's bold move in the ETF arena. Also today, we're talking about Bitcoin's potential moonshot to $100,000 and beyond. Buckle up. It's about to get wild in the crypto jungle. Let's talk money. Juke Morgan just sounded the alarm on Bitcoin, predicting a roller coaster ride if the SEC gives the green light to spot Bitcoin ETFs. Analyst Nikolaos Panagritsadlou spills the tea, estimating a whopping $2.7 billion could exit the crypto stage as Grayscale's Bitcoin Trust, KBTC, transforms into an ETF. If that cash takes a nosedive out of the crypto world, get ready for severe downward pressure on Bitcoin prices. It's a financial roller coaster, and we're hanging on for dear life. In the ring with former Goldman Sachs heavyweight Raoul, Tapiero's pointing out a game changer in the crypto landscape. Big dogs like Adidas, LVMH, and Nike are sniffing around non-fungible tokens, NFTs, and financial titans like Franklin Templeton, Fidelity, and BlackRock are rolling up their sleeves for a crypto showdown. Tapiero calls it an adoption cycle, a shift in the wind where traditional giants are no longer tiptoeing, but diving headfirst into the crypto pool. The market trends are backing up the Bitcoin bull parade. Galaxy Digital's predicting a 74% price boost in the first year post a Bitcoin ETF launch, and algorithmic models are singing sweet melodies of Bitcoin hitting $137,400 by 2025. But of course, not everyone's throwing confetti. Dr. Prof's waving the caution flag, reminding us all that Bitcoin needs to stay above that 20-day simple moving average at $36,287. Otherwise, we might see a retracement to $33,000. Dan Tapiero, the CEO of One Roundtable Partners, just dropped a bomb on the crypto world. Brace yourselves for a potential Bitcoin rally to $100,000. But wait, that's not all. Dan isn't playing it safe. He thinks this is a conservative estimate. We're talking 160% gains, people. Dan's been in the game, and his target for Bitcoin back in 2019, a jaw-dropping $250,000 to $350,000. The man's seeing the future, and it's looking like a crypto gold rush. In the left corner, we've got Arake Investment Management throwing some serious punches in the ETF arena. Their Arake 21 shares Bitcoin ETF is making waves with a jaw-dropping 0.8% fee. That's right, you heard it, 0.8%. They're undercutting the competition like it's a crypto price war. Grayscale's Trust charging 2%. Forget about it. ProShares BITO at 0.95%. Not Arake's house. With the SEC's decision looming on January 11, 2024, Arake is playing the game hard, aiming to be ETF champ of 2024. And there you have it, money talkers. Bitcoin's roaring into the future, and $100,000 might just be a pit stop. Let's continue our discussion with Raoul.
So when you debase a currency, it doesn't let wages go up or even corporate earnings go up. It makes asset prices go up. So those who can afford assets outperform or at least protect their wealth. Everybody else who earns wages and doesn't have much assets, they get their future self. An asset is your ability to put money in now and take it out later. It's future deferred consumption. If you can't buy assets, your future self is getting poorer. That's why we have a pension system. That's why people buy real estate. That's why they buy gold. All of these things. So what they're doing by debasing the currency by whatever the number is, 15% a year, is they are mutualizing the costs of servicing the debt. But it's mutualizing it across the poorer people, which is what makes everybody so angry. Because they don't understand this card trick that's being played on them. It's the same as raising taxes on them all, but they don't realize. They just know that something's not right. Why do my wages not really go up, but everything else goes up around me? Why can't I afford a house and my parents could afford a house? Why could my parents have, a larger percentage in their 401k and I can't? It's because of this. And that's what the central banks are doing. The destruction of the American dream has come from that real wages haven't really ever gone up. That's the dirty secret. Nobody really got richer. And everybody financed consumption via debt, which made their future selves poorer as well. And so that's been a real problem for people. So then you say, okay, the millennial cohort, what do they do about it? And I did that piece, that famous YouTube video called The Retirement Crisis, where I said, well, if you're a millennial, you have basically one choice, which was crypto. And that was, 2016 or something, I did that video. And the point being is millennials are very good because they invest in their 401ks. They kind of do as they're told. but it's not enough because you can't get up the housing ladder and you can't do other things. So in 2020, they learned a new trick, which is risk-taking. So with their disposable income, they've been huge buyers of crypto, by far the largest cohort, because it has a massively skewed risk-reward. So it gives them a chance. The other thing they did was trade technology stocks, because they rightly identified that they go up more than the S&P 500 and boring stuff like GE. And then they started trading in with options, because buying a lottery ticket for them is kind of the only choice that they've got. Now, so it is intelligent risk-taking because they're actually still investing in their 401ks. And that's why crypto has resonated so well for people, because they can see a way out. But it's hard because it's very volatile too. But that's why it's kind of gripped the younger people, as have technology stocks. That's why people love Tesla. It might produce amazing cars, but it also has produced amazing performance for people. And people need that because there's no other way, because it's not going to be made up with wages.
If you enjoyed the video, don't forget to give it a thumbs up and subscribe to our channel for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.